Yes, as Hunter mentioned, I used to be, a long time ago in a galaxy far away, I was a professor of economics, and this actually kind of reminds me of those days, these big kind of auditoriums. It's kind of great to be back here. And I noticed that I've got two students sitting up here in the very front who are bucking for A's. Just saying. LG, I'm not going to count you. No. Okay, so what I'm going to talk about here is, it says the global economic outlook. It's not going to be truly global in the sense of really going to focus kind of on the United States, talk about a little bit about the Eurozone and China, talk a little bit about some long-term sort of issues at the end of it. But, you know, if you're looking at the United States, you're looking at the Eurozone and China, you're looking at 60% of global GDP. So it's, you know, on first order, it's essentially the global economy. So let me kind of tee it up, and this is where the economy is today, or at least where it was at the end of February, early March. We don't have a lot of economic data yet for March yet to really know exactly what's going on in real time. But so what I'm showing you here these are what's called purchasing manager indices, okay? And the way these things work is when the line is above 50, which is the line going across the middle there, activity in that sector tends to be expanding. Whenever you're below 50, activity tends to be contracting. And so this is the look back in February. If you look at the red line, that's for the manufacturing sector. It's a little bit below 50, so perhaps manufacturing has stalled recently. But if you look at the blue line, that's the service sector, and that's doing very, very well. That's still well above 50, or at least it was back in February. Another data point we can look at is in terms of employment change. And so if you look in February, that last bar there, we created more than 300,000 jobs in the month of February. And just to put that number into perspective, because I know it probably doesn't mean a lot to people, if you go back and you look at the last expansion between 2010 and 2019, on average, the economy created about 190,000 jobs per month. So we're creating, in February we did 300,000. So that's well above average. Again, signs that the economy remains pretty resilient. Of course, we've got this issue going on. This is inflation. The good news is it's come down, the inflation rate. Last summer we were clipping along at about a 9% rate. It's the highest rate since the early 1980s. I'm looking out here at the audience. I think some of you folks, I'm not going to name names, I think some of you folks may remember those days. But it's the highest rate we've seen since the early 1980s. The bad news is it's still around 6% or so. It has come down, but it still remains relatively elevated. And so now what I'm going to do next is I'm going to drill into that a little bit more to show you where the inflation is coming from. So first part we're going to look at here is what's called core goods. So this would be all the goods in the economy excluding food and energy. We exclude them here just because it's really volatile. This is about 20% of the CPI. So, examples would be, the coat I'm wearing, the watches you're wearing, your iPhones, et cetera, et cetera. Okay, and so the blue line there is the year-over-year rate. And what's interesting, if you go back to 2021 and early 2022, you see that really coming up. Okay, and so what was happening back then was, you had the different stimulus sorts of programs. So people had a lot of money floating around. This is back when the service sector was more or less shut down. People weren't going out to restaurants, they weren't traveling, et cetera, et cetera. And so we're Americans, the money burns a hole in our pocket, right? We want to spend it somewhere. So what happened? We spend it on goods. Okay, so the demand for goods really goes up. At the same time, this is where a lot of supply cutbacks have been. LJ talked about supply chain problems. All right, so what happens when demand really goes up and supply goes down? If you don't remember your Econ 101 days, I'll tell you the answer. Prices go up. Okay, and you can see they went up pretty dramatically. So about last year at this time, the inflation rate in terms of the goods sector was double digits. Now look what's happened over the last year, right? That's come down, and on a year-over-year basis in February, it's essentially flat. It's only up 1%. What's happening here is there's been a rotation away from goods towards spending. That's where the pent-up demand has been. People, if you've been on an airplane lately, you know what I'm talking about there. Right, so we've been to restaurants, okay, so rotation away from goods, so the demand for goods has decelerated. At the same time, I'm not going to say supply chains are back to 100%, but they're a lot better than they were a year ago. Supplies come back online, and look what's happened to prices. All right, that's the good news. Now let's look at the surf zone. This is 20%. Let's look at 60%. You see any coming down in inflation there? No. Okay? And so if the Fed wants inflation to go back down to 2%, just the way the math works, this is 60%. This has to come down. Okay? And so how does that happen? Well, when you think about services, the biggest cost component for most service providers are wages and salaries. Okay? And so what you've got to do is you've got to get wages and salaries to start to slow. In other words, you've got to generate some, we'll call it slack in the labor market. That's a euphemism. You've got to have the unemployment rate come up a little bit. Right? And so what the Fed's trying to do with its interest rate hike is trying to slow the economy enough that you generate some slack in the labor market and wages and salaries start to decelerate. Okay, so how are we doing on that score? So let's look at the labor market. Here's the unemployment rate. In February, 3.6%, 3.4% in January, but essentially it's a 60-year low. Right? We're not seeing a lot of slack there. And then when you look at wages and salaries, there's lots of different ways you can measure that. Here's one of the most popular ways, because we get this on a monthly basis. This is what's called average hourly earnings. The blue line shows you the year-over-year change. It's come down from 6%, but it's still running north of 4%. And if you just look at the last cycle, you can still see it's well above that. This is not consistent with 2% inflation. This has to come back down more to like 3% or so. And so, what the Fed has been doing, it's been raising rates again to try to slow the economy. All right, so that's where we are right now. And, a few weeks ago, we had this little thing that's going on in the banking sector right now, okay? And so what I'm showing you here is what's called the Bloomberg Financial Conditions Index. Essentially what this does, it takes 10 financial market variables, like the stock market, like credit spreads, volatility in the stock market, et cetera, and it puts it all together in one index. So you can see, in just one glance what's happening. And the way this thing works is when the line goes up, financial conditions are becoming easier. When it goes down, they're becoming tighter. And what you can see is over the last few weeks, the financial conditions have tightened a lot. You probably all follow the stock market. You know what's happened there. For me, what's more important is what's happening with credit spreads in the credit markets. Those things have widened recently. So there's been a real financial tightening that's happening. Now, put it in perspective, you also see March of 2020, when things started to lock up. We're nowhere close to that. And if I went back even further, if I showed you the financial crisis, I showed you the fall of 2008. On the left, you see the numbers there. That line went down to -12. Okay, so we're not anywhere close to that yet. But the point is, we're having a financial tightening. Now, so now I'm going to transition, start talking about what does this all mean for the forecast, okay? And so every economic forecast is predicated on just a number of underlying assumptions. And typically we don't bore you with a lot of these assumptions because, implicitly there's hundreds of them. And if I sat up here and talked about all of our assumptions, I'd put you to sleep, even more. Okay? And so for instance, right, we all know that the United States and North Korea could have a nuclear exchange at any time, okay? How do we handle that in our forecast? It's easy. We assume it doesn't happen, okay? If it does, we change our forecast, okay? And the reason we assume that it doesn't happen is, we all know that the probability is probably pretty low. It's not zero, but it's pretty low. And therefore, it'd be kind of stupid to base an economic forecast on something that has a really low probability of that. But when things get really uncertain like they are right now, it's incumbent upon us forecasters to make some of those assumptions explicit. So you know what we're thinking as we talk about our forecast. So what we are explicitly assuming here is in coming days, weeks, or months maybe, the authorities, Treasury Department, the Fed, FDIC, etc., the authorities take whatever steps are necessary to make sure this doesn't become another 2008. We think that's a relatively reasonable assumption because if you go back into history, when you think about what happened in 2008, the authorities in general, whether it was Congress through the TARP or whether it was all the programs that the Fed put into place, there was a financial crisis, but that could have been a lot worse. It was bad, but it could have been even worse. It could have been a Great Depression had not they done what they did back then. The same thing back here in 2020, right? The Fed and the authorities got really quick in stabilizing the system. So we go look back in history, we think that's a relatively reasonable assumption. And what I would also say is when things have kind of settled down right now. Now that's not to say you couldn't have some other sorts of problems in the coming days, weeks, and months. Warren Buffett once famously said, it's when the tide goes out, you find out who's been swimming naked. Okay, we know there's been at least 2 naked swimmers so far. There's maybe more out there. Okay, but again, what we're assuming is they can take whatever steps is necessary. I don't know what those steps are. They don't know what they are. They'll make them up as they go along to just make sure that this doesn't become a financial sort of crisis. Okay, now if they're unable or unwilling to do that, then our forecast is wrong. Okay, so now even if that assumption is correct, and they take the steps to shore everything up, I still think there's going to be some consequences for this. Okay, so what I'm showing you here, this is credit growth. The bars are just different credit to different sectors, stacks up to the overall sort of thing. I talked about credit spreads in the corporate bond market widening. This past 2 weeks, there's really been very, very little issuance in the corporate bond market. And that's really important. When we think of credit, most of you folks probably think of bank lending, and that's an important part of the economy. But the US economy is a largely capital markets financed economy. And if issuance in the corporate bond market goes to zero, things are going to slow really quickly. Now, I think some of that issuance will probably come back online. But when I look at bank lending standards, I think you're going to see tighter lending standards. In other words, credit's going to become more dear. It's going to be harder to get. And I think that's going to have some economic ramifications. And so when we look at GDP growth, so the left-hand side is where we've been, the right-hand side is where we think we're going. So as you can see there, we've got some negative bars later this year. We were one of the first Wall Street banks to actually start calling for a recession. We went to that recession call last summer when we saw just the inflation that was going on and the Fed's interest rate hikes, et cetera, et cetera. Now, full disclaimer, we've had to push back the timing of when we thought the recession would start because the economy has shown a lot more resilience. But we still have a modest recession here. And whenever I say the R word, right, people just go, oh, right, because they think of the last two. So the last one was in 2020. And matter of fact, that was the deepest recession we've had since the Great Depression. In that 2-quarter sort of period, real GDP contracted 10% over that period of time. Now, I would also say that's not a typical recession, right? That was a response to a pandemic. And God willing, we're not going to have another one of those for 100 years. So that's not a typical recession. But if you go back and you look at the one before that, the so-called Great Recession, that was pretty deep and nasty. Okay, so the benchmark is whatever I say recession, again, people go, oh, okay. So we're looking for a contraction in GDP in the economy of roughly 1 to maybe 1.5%. I know that doesn't mean anything to anybody in this room. So put that in perspective. I already mentioned the pandemic was 10%. The financial crisis was 6 quarters, accumulating to about 4% of GDP. Here we're looking for 1 to 1.5%. As recessions go, this is relatively modest. And I'll get to that in just a second for why that is. Now, if I walk out on Tryon Street and I grab 100 people at random and I say, tell me about a recession, most folks aren't going to talk about GDP. Most folks don't know what GDP is. Okay, when they think about the economy, they think about the labor market. That's what they see all the time. Okay, so in other words, the way to think about it is, here's our forecast for the unemployment rate. Right now, we're around 3.5%. We think by the end of this year, early next year, we'll be up around 5% or so. Okay, that's a change. That's a delta of 1.5 percentage points. You see the aftermath of the financial crisis. We went from 4.5 to 10. That's a delta of 5.5 percentage points. So this is a recession, but again, as recessions go, this is relatively modest. Those of you who are old enough who remember these sorts of things, if you think back to the early 1990s, we had a recession in the early 1990s. this is kind of equivalent to that, we think. It's certainly painful, but it's not financial crisis, sort of things. Here's the Fed. The Fed, as you know, last week they raised rates by 25 basis points. So far in this tightening cycle, they've gone 475. This is the fastest pace of tightening since the early 1980s, when we also had an inflation problem. And we think that they're probably pretty much being done at this point. If our assumption is right and things remain stable between now and May 3rd, which is their next meeting, we think they bump rates another 25 basis points or so. The market really isn't priced for that. The market's kind of 50% of that, but a month from now is a long time. And we just don't think they're going to have enough signs of deterioration in the economy to prevent them from going again. We think they're probably going to go one more time. And then what your eye sees is the red line coming down a lot. So there's a big easing cycle coming, but we don't think that really starts until next year. We essentially think the Fed's on hold all year long. Even though the economy's starting to weaken, et cetera, we think the Fed keeps rates where they are until they are sure inflation's coming back down to 2%. That's their number one overriding goal right now. I mean, I would point you to, if you want to see what they're thinking, just Google Jerome Powell's Jackson Hole speech. It's a speech he gave in Jackson Hole, Wyoming, back in August. And most central bank speeches are, very opaque. One hand this, the other hand that. Very, very nuanced. This is, I would refer to this, without trying to be too dramatic, as the Gettysburg Address of central bank speeches. Right? It was short, to the point. This is what we mean, sort of thing. Okay, and essentially it was saying we're going to do whatever it takes to limit inflation. We've gone back, we've looked at history. The problem that the Fed made in the 1970s is they let up on the brake too soon. And then inflation became entrenched, and then it became really difficult to get it out of the economy. We're not going to make that mistake again. We'd rather have a short, modest recession now to bring inflation back down to 2% than have to do that all again a few years from now and put the economy through a really ringer. Okay, so, and they're all preaching from the same hymnal right now as well. So I think it's going to take them a lot to be bringing rates down. The rates come down next year is because, well, we are in a recession and we think inflation's going back towards 2%. And that's when they start to cut. All right, let me talk, so why is this a relatively modest sort of recession? I can show you a lot of charts. But just for the interest of time, I'm going to show you one here. This is household liabilities, essentially household debt, measured as a percent of disposable income. I think I've shown this chart to you before. People refer to this as leverage. Okay, and so that Mount Everest there in the middle of the chart, that's the housing bubble, when the household sector got all levered up. And look what we've been doing for the last 15 to 20 years. That ratio is back to where it was before the housing bubble started to inflate. Again, I was, a long time ago, I was a professor. I know how to give letter grades, right? So if I had to give a letter grade to the financial position of the household sector today, it's a solid B. Maybe it's a B plus. Okay, whereas 15, 20 years ago, a D. And frankly, I didn't like to fail people. So I'm being easy in terms of my grading back then. So point is, things just aren't all levered up like they were back then. The banking system today is the best capitalized it's been in my lifetime. Banking system, that doesn't mean there can't be individual banks. But the banking system is the best capitalized it's ever been in my lifetime. So again, I would think if we do have a recession, I think it's going to be a relatively modest sort of affair. Let me talk about Europe. If we were in here 6 months ago, I would have said to you that the outlook for Europe is really dire. Okay, and so what we're looking at here is looking at natural gas prices. The blue line is natural gas in the United States, the red line is in Europe. Whereas oil is really, truly a global market. And what the prices they pay for oil in Europe are more or less what they are here in the United States. Because natural gas isn't easily transported. I mean, there's some, right? There's some liquid natural gas, but it's not like oil tankers. You can get these big price divergences. And so what you see here is this is what's happened when Europe gets a lot of its natural gas, or did get a lot of its natural gas from Russia. It's like 40% of Germany's natural gas comes from Russia. Okay, and so you had this huge spike last fall there. And it looked like the outlook for Europe was pretty dire. because of that. Now look what's happened to that red line. One of the best things that happened to Europe this year is they had a relatively modest winter. And they took a lot of good steps to conserve energy as well. So right now, inventories of natural gas are pretty high. And so suddenly the outlook for Europe isn't as bad as what it was, say 6 months ago. And just to kind of give you a sense of that, here I'm showing you these purchasing managers indices again. These are the ones for the Eurozone. So the blue line is manufacturing, as you can see in February, again, modestly below 50. But the service sector in the last month or two has actually poked its head above 50. And so, things have improved there. In terms of inflation, Europe also has an inflation problem like we do. I mean, most places do. I'll show you a chart in a second where they don't. But Europe is having a little bit of an inflation problem there, although it is starting to come down, at least the headline rate. And what that's doing then is if you look at a bunch of lines here, look at that kind of, what is that? It's lavender, right? So that's the year-over-year change in what's called household disposable income. And so this is all in real terms. This is inflation adjusted and it's after taxes as well. Another way to say this is purchasing power. And one of the things that inflation does, if wages aren't keeping pace with it, it erodes your purchasing power. And that's what's kind of happened in Europe, as you can see. And so then that's, as you can see, that line, the lavender line is highly correlated with the dark blue line, that's consumer spending. And so, we think that the consumer spending has slowed, growth in consumer spending has slowed. We think you're going to see more of that in Europe. And I'll get to our forecast here in just a second. ECB has also raised rates dramatically over the course of this year. We think they probably got another 50 to 75 more basis points of tightening there because of the high inflation rate. And then that combination of the erosion of purchasing power and tighter ECB policy. Again, we've got a modest forecast here in Europe, starting a little bit before ours. We think we don't have the fourth quarter quite yet. We essentially believe that's going to be essentially flat on the quarter, and then you can see a modest decline there. But again, the outlook in Europe has gotten a lot better, given what's happened to energy prices there. And then finally, China. I talked about inflation. China doesn't have an inflation problem at all. Largely, this reflects the lockdown of that economy that has occurred. Here's GDP growth in China. You can see that's really volatile over the last few years. This kind of reflects locking down, opening up, locking down, opening up. As you probably know, in China they've gotten rid of the zero COVID sort of policy. And what I would say is that eliminates a big downside risk, not only to the Chinese economy, but to the global economy. Right? At any time COVID would spike, they would start to lock down cities. It's one thing to lock down Beijing. The rest of the world is not that intertwined with Beijing in terms of an economic sense. Shanghai, Guangzhou, completely different story, right? And so if they're locking down Shanghai, if they're locking down Guangzhou, that just gums up supply chains. So that's that downside risk now is kind of behind us, hopefully. Our forecast is we think growth is going to pick up in China in the next year or so, at least on a year-over-year basis. But look, what's interesting here is look where our forecast is, and then look where we were even before COVID, and then go back 10, 15 years. 10, 15 years ago, China was growing 10% on a year-over-year basis. That's never ever going to happen again, at least not on a sustained sort of basis. And I'm going to get to that in just a second. So if we aggregate everything up, here's global GDP growth. Growth. Going back to the bars are the annual growth rates. And then that red line that goes across is the average. And so the global economy, on average, since 1980, has grown about 3.25% per year. And so the red bar there, that was last year, the first red bar. We don't have the actual number, so it's still a projection. It looks like because everybody was weak last year, we're probably below average. This year, we're going to be below average. Next year, we start coming back up. But then the big question is, as you go further and further out, what happens to that? And let me finish up and talk a little bit about some longer term sort of things. Long-term economic growth, and we typically think about this when we're looking at an individual economy, but the concept would still be the same when you're looking at the global economy. Long-term economic growth is really dependent upon two things at the end of the day. One is the growth rate in the labor supply. So the more people that you have to be able to make widgets, the more widgets you can make. And then the other thing would be productivity growth. You don't necessarily need to have more people, but if those people can make more because of productivity growth, that's also a long-term driver. This is an interesting chart. This isn't our projections. This comes from the United Nations, the demography part of the UN. And you can see, we've been slowing. Global growth has been slowing. Global population growth for the last 20, 30 years or so. Red bars on the forecast there. So in and of itself, that's not a great thing about long-term global growth. And then if you look at different areas, so what we're doing here is looking at different areas. And the way this chart works is everything is indexed to 100 in 2020. And that way you can see percent changes since 2020. So let's start at the bottom there. That's the left. So if you look at that kind of pink line, that's Europe. So the United Nations projects between 2020 and 2050, the population and this is working age populations. This would be people 15 to 64. The working age population in Europe is going to go down 20%. As you probably all know, Europe is older. And if you decompose this even further, if you look at Eastern Europe, if you look at Russia, look at Ukraine, and even barring what's happened over the last year, the demographic outlook in those countries is awful. Okay, so North America is kind of that orange line. Looks like population in North America is going to go up over the next number of years, the next 30 years by, let's call it 15%. That still represents a slowing in the population growth rate. And then you got Asia up there as kind of in the orange sort of line. Look at the blue line. Look who's going through the roof. That's Africa. The population in Africa over the next 30 years is supposed to double. Can Africa be an offset to China? I'll show you China in a second. Can Africa be an offset to China? Can Africa be the next China? I'm a little skeptical. I mean, China is a sovereign nation. How many sovereign nations are there in Africa? I'm guessing 50. They all have their own economic policies. They don't all march in step, blah, blah, blah. I think it's safe to say that the underlying institutions in many African countries, I'm not going to say most, but in many African countries are weak. I just don't think Africa's the next China, right? And then when you look at, so this is, now we're looking at Asia. So that orange line, that's Japan. The working age population in Japan has been declining since the early 1990s. It's come down 20% so far, and the UN projects it's going to go down another 30% between now and 2050. Look at the blue line. That's China. Working age population in China is topped out. It's going down. Everything else equal. Long-term economic growth in China is slow. It's going to go down 20% over the next 30 years. Projections. Right? You got Indonesia and India up there doing pretty well in terms of population growth. But China is not going to grow like it was before. And so the last chart I'll show you here is now I'm looking at non-financial corporate debt. This is business debt, measured as a percent of GDP. The bottom line is us. If you look at us, business debt in the United States is about 80%. If you look at China, that ratio is double. China has a debt problem. And when I think of China, one of the 10, if you say to me, China, give me the first 10 words that springs to your mind. Japan is going to be there. I think China very much could be another Japan. They've got the same demographic problems, and so just keep this in mind. The Japanese economy has been more or less stagnant for the last 20 years. I'm not saying China's going to stagnate soon, but given its demographics, given its debt problem, it's not government debt like it is in Japan, but it's business sector debt. I think there are some real issues there. And so, just to go back, the last chart I'll show you again, if you look at China here, I said this earlier, they're never ever again going to grow 10%. I think 2 or 3 years from now, they'll be lucky to grow, or 5 years from now, they'll be lucky to grow 2 or 3%, given some of the issues they have there. And so what that means then for the global economy is if you take China out of it, and everybody else is kind of slow, I think these bars are going to kind of struggle to get back up to the average. The only way that could change, in my view, in the long term, would be Remember the two things that drive long-term economic growth? It's labor force growth and productivity growth. If you have a productivity revolution, that could change that. We are on the cusp of a productivity revolution. We talked a lot about it before the pandemic, and then it went away. Because of the pandemic, we didn't talk about it. We've been talking about it for the last 2 or 3 months. AI.